This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Well, Luke Smith, thanks very much for coming on Talk Your Book. I thought it'd be a good place to start if you walked us through Ausbil and maybe the resources fund that you manage there.
Yeah, thanks, Chris. Appreciate you having me on. Yeah, firstly, in terms of Ausbil, we're a boutique fund manager based out of Sydney. Get a bit over 11 bill of, or roughly 11 bill of FUM. In terms of our investment style, it's defined as core, which sort of means that we're style agnostic, growth or value. We look at things from a top down and bottom up perspective. So we're really including the macro in our decision making process around stocks more broadly, and really we've got a big focus around earnings as the key driver for stocks more broadly. And then in terms of my position at Ausbil, myself and a colleague cover resources sector for the team, but we also run, and I'm one of the two portfolio managers on Ausbil's Global Resources Fund that kicked off roughly two and a half years ago. Like it's a long short fund. We aim to make money through the cycle. Aim to protect capital in the lows of the cycle, and then participate in the upside.
And we'll get into the stock you want to talk about shortly, but what's your helicopter view of the resource sector at the minute?
Yeah, we like it. We think we're at early stages of a multi-year bull cycle. Obviously, I'm biased, so I have to say that. But
at least if you're long or short, you're not not completely biased, are you?
Yeah, agreed.
Resource stocks.
Yeah, no, agreed. So, and we've had a bit to work through, but look, really, our thesis around what we're heading into is that commodities demand is strong and accelerating. China's really put the hammer down post the COVID lockdown that we had earlier in the year. The rest of the world is recovering, and it's going to benefit from all the stimulus that's being injected into the system. And then at the same time, these issues around supply as well, and these COVID-related shutdowns in the key producing nations, clearly supporting commodities at the moment. But ultimately, over the medium term, there's just been a lack of investment in new supply that, really for us, those both accounts, should have the market tight for a number of years to come, and that's ultimately supportive for resources equities as well.
And what stock do you want to talk about today?
I'm going to talk about Northern Star Resources, good gold stock. It's the second largest gold stock on the ASX with a 10 bill market cap. It's got pretty much everything that we look for in gold companies. Like I said, we're focused on both top down and bottom up, and clearly that's supportive, for on both fronts there. It's got a diversified and growing production base in tier one locations, and it's got an exceptional management team. So, just to point reinforce, while I can't make an investment recommendation, hopefully some of this gives a good background on the story regardless.
And what's your top-down view on gold before we dive a little bit deeper into NST? Yeah,
we like it. Gold's had an exceptional run this year. It's up, roughly 30% so far this year, and it's probably worth outlining the key drivers for that. But really just highlight that we think those drivers are going to be continued over the medium term. Firstly, there's a high correlation to negative real interest rates, and that's the starting point for gold as a start. Central banks are looking to support economies in general, and really drive stimulus into the system with where rates are at the moment. Secondly, in terms of the currency environment, is extremely supportive. One for gold, but also for the broader resources space as well. That this weak US dollar environment, devaluation of fiat currencies is very supportive for the commodity. And then just finally, just that heightened, sort of macro uncertainty across the real economy as well feeds into a discussion around gold as well. And really that's been a big driver behind commodity this year. we've seen record inflows into the gold ETFs more broadly. We're starting to see non-traditional players, like pension funds. You're starting to see news flow start to play into the commodity as well. And look, those key drivers aren't going away anytime soon. And we'll likely see this environment maintained. And then finally, I don't know if I've given you enough points, but then finally, the next question just comes back to inflation. And, there's a potential for an inflationary environment to rear its head, given the level of stimulus that we're seeing. And really, the Fed outlined recently that they're going to let that run. And it's another factor that clearly could support the commodity as well, that gold's a solid inflation hedge.
Does the optionality of a deflationary bust give you comfort as well, that if there is a short-term deflationary environment, the amount of printing that the central banks are going to embark on to try and stop that's going to be even more obscene, and that optionality of either high inflation or deflation being good for gold, does that give you a bit of comfort as well?
Yeah, it's just going to reinforce the value of physical assets in that environment, clearly. So it's not going to be a straight line in terms of how the commodity plays out. We've seen that more recently in terms of some of the volatility within gold more broadly, but this backdrop, it's hard to fault at the moment from a macro standpoint.
And so in terms of Northern Star, recently took an investment in Super Pit in Kalgoorlie. Maybe talk us through what they've done there. Yeah,
sure. So, I guess as a starting point around some of the background for Northern Star, this is effectively a 10-year-old company. It started, mid sort of 2010, market cap of 10 million. Now the company's 10 billion odd. It's a real success story, one of the mining space, but of the ASX more broadly for the last decade. Sort of outline a couple of real drivers behind that, and the heart of it all is this management team and the operational team that are sitting behind this business, that have really like I said, driven the success of this business. Now, to your question around Super Pit, Super Pit's going to be another example from our perspective that reinforces the success that this management team has. Its operations. They've been highly successful in the past in buying assets and turning them around. It comes down to one, either an operational turnaround, productivity enhancements, or really putting the foot down in terms of exploration and improving these assets in general. So, specifically around the Super Pit, they picked up a 50% stake off Newmont late last year. That followed on from Saracen, who similarly picked up a 50% stake in the asset earlier in the year from Barrick. So effectively, you've gone from an asset that sat in the hands of the gold majors for some time to now sitting in the hands of two very nimble operators, Australian gold miners that have extremely complementary skill sets, whether it's open pit mining or underground mining, that the two companies effectively specialise in, and we're already seeing some of the benefits start to wash through there. They've held the asset for less than 12 months. The reserves have grown by 50% already. They've outlined a production case that will similarly see production grow by 50% over the medium term as well. And look, at the moment, like I said, they haven't held it for a long time, and we think some of the assumptions there are conservative as well. And this is an asset that's going to have material impact on the company for some time to come.
What about the 2018 acquisition of the Pogo asset in Alaska? How's that travelling in its turnaround?
That's another asset that they picked up, like you sort of highlighted 2 years ago. They picked it up off Sumitomo as the first major investment, for them outside of the country. And it's a similar discussion to the Super Pit. That they're buying an asset that's effectively been starved of capital for some time, short mine life, but very well capitalised asset as a starting point, high grade, getting in there and exporting their talent to Alaska and look to lift productivity, drop costs, focus on exploration, breathe new life into this asset. And they're on the cusp of getting there at the start of the year, and unfortunately, a thing called COVID stepped in and slowed down some of the progress there. Clearly it's difficult to maintain that level of productivity and issues around travel and etc. That when you've got a workforce that is getting infections as well. So, look, they're on the cusp of turning that asset around. It's been delayed somewhat, but that doesn't mean that they're not going to get there. And ultimately, as they can get back in there and work the asset harder, that there's going to be real potential at that asset, both from the existing operations, but then the near field exploration as well.
And what does the medium-term production growth look like across the entire entity?
Yeah, well, look, you start with those two assets that we've talked to, and you throw in Jundee as well, that has got growth as well, and like it's a difficult situation for mining companies in general to maintain production. These are finite resources, so we've got a company sitting on three assets that are growing either at early stages of turnaround or just have growth through decent acquisitions that they put in there, and we're expecting production growth in line with guidance for 25% over the next couple of years, and the point to reinforce with that is that not only will they have this level of growth for the next 2 years, likelihood that they maintain that sort of production at sort of 1.3 million ounces, like the company's sort of guiding to for the remainder of the decade. And with that as a backdrop, they're also dropping the cost base as well. So it's a unique situation where you've got a company of this size that's able to grow its asset base and really should provide a good backbone for the story.
Relatively low hedging in place. I think their hedging levels are something around 15% of production. As a gold bull, does that give you comfort they're going to share in the upside if this gold price continues to run?
Yeah, that's a really good point, and you're right there in terms of the level of hedging. That's it's about the level that they've got. Some level of hedging, is appropriate for these gold companies. We're comfortable with that, but at the same time, that you get your margin expansion as an environment that we're outlining that we can see that gold price can continue to strengthen, and therefore to my point around cost reduction, you should really see the full impact of margin expansion, in the current backdrop. There's been, very strong free cash flow generation out of this business already, and that's likely to continue. There are reasonable licks of capital that they need to direct towards probably the super pit as a starting point, but there's a lot of margin that's going to be generated out of this business, and look, that's already been reflected in the special dividend that they paid at the recent result. But if anything, we're likely to see free cash flow continue to strengthen in time.
And their balance sheet looks really strong due to that free cash flow. Do you think there's potential other acquisition opportunities out there which would be a nice fit, or do you think it'll be more used to pay increasing dividends going forward?
Can't rule it out, but I think they've got enough on their plate at the moment. There's Super Pit's a beast. There's a lot of work that they're going to put in there, and this is a 15-year asset that that they're really going to accelerate in terms of production outputs. So I think they've got their hands full at the moment. I think it's probably the opportunities that have presented themselves, they were opportunistic when they picked it up through time. You can't rule it out, but I think the M&A that we probably see from Northern Star in the near term is more likely to be sort of opportunistically that can be sort of tagged into the existing assets that we might see in Kalgoorlie, or otherwise it won't be at the same scale that we've seen in recent years from Northern Star. So no and yes to some degree, but I think there's enough on their plate already.
And talk to me about their valuation and maybe their free cash flow and what they're able to generate there in more detail.
Yeah, sure. So like I said, you got a company that is generating strong free cash flow at the moment, and that's going to improve in time. Consensus has them on an 8% free cash flow yield, and clearly that grows with the backdrop that I'm sort of presenting. That's yeah, it's ahead of its peers, and both from a domestic perspective and an international perspective. So, not only have you got all of this as a backdrop, you've got a reasonably priced company as well as a starting point.
And their assets are all in tier one jurisdictions. I sort of have a view that if you're really confident in the underlying commodity, it makes even more sense to be in tier one jurisdictions. If you're not as confident, it maybe makes more sense to be a bit more adventurous in the type of jurisdictions you're going to venture into. Do you subscribe to that factor at all, or do you just have a heavy bias towards tier one jurisdictions in all environments?
Well, I think the point is that you get a high quality company and you've got lower risk. That you've got all these things that I'm outlining in terms of the positives, around the story. If it's the macro, if it's the bottom ups, turnaround of these assets, exceptional management team, best in class, and you're not taking the risk in locations. So becomes an easier investment decision, I guess, if you don't have to take the risk on location. It's not saying that we won't when we assess companies. It's just about understanding that risk, but it's not to say that there aren't risks within these businesses and this business in particular. But removing that jurisdiction risk is one positive that enables you to sleep easier at night.
Beautiful, mate. You paint a great picture. It's always nice to get a gold bull on and give me a little bit more confirmation bias. So really appreciate you taking the time.
Thanks, Chris.
Thanks, mate.
This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.